Hello and welcome back to the American Dream Portfolio. Before we get to today's topic, the importance of the benchmark. We think it's important to let new viewers know how this channel operates so they can get maximum benefit from our videos. Unlike most channels, ours offers a linear, step-by-step progression of information rather than a collection of videos that can each be watched independently of the others. To get the best results from watching our videos, we recommend that you start with our first video entitled Start Where You Are with What You Have, and continue watching in the order that the videos were released. This is because the concepts, information, and ideas we present are designed to build on each other as we delve ever more deeply into the topic of reaching for and achieving the American dream. Now on to today's topic. Imagine that you are reviewing your 2025 year-end investment statement and it shows that your portfolio gained 13% for the year. Is this result cause for celebration? After all, 13% is noticeably better than the 9% annual return we suggested we would need to get American Dream results. But remember that the 9% figure represents an average over many years. No investment currently available pays 9% every year. Yearly results will fluctuate. So what are we to make of that 13% gain for last year? Well, what if I told you that the stock market, as measured by the S&P 500, was up nearly 18% last year? What do you make of your portfolio's performance now? These questions relate to a very important investment tool known as the benchmark. A benchmark is a reference measurement that an investor can use to gauge the performance of their portfolio year by year. It can also help assess the suitability of individual investments, like stocks, to help decide if those investments should be added to or removed from your portfolio. As we begin building the American Dream portfolio, we will show you how use of a benchmark is not only very helpful, but necessary. Before tackling the question of the 13% gain, it is necessary to specify the key characteristics of a useful benchmark. First, because a benchmark is a reference or comparison measurement, it should always have value. Therefore, a benchmark must be durable. It should not offer the possibility of going to zero. This requirement rules out individual stocks, corporate bonds, and real estate investment trusts as possible benchmarks. Second, the price movement of a benchmark should not be excessively volatile, which means it should not exhibit large, erratic moves up and down the price chart. We accept that all investments move up and down in value, but a good benchmark should be as restrained as possible in that regard. This will allow it to serve as a dependable reference measurement of performance. This requirement rules out gold as well as the investments listed above. Third, the performance of the benchmark over time should meet your investment needs. For us, that would be 9% per year on average. It's no good selecting a benchmark that could lead you to underperform the investment goal you are striving to reach. This requirement rules out government bonds. Finally, a good benchmark is one that you can invest in directly if you choose. It's no good selecting a benchmark that passes all the other tests if it is unavailable to you. This would rule out a wide selection of investments designated as private or alternative. Okay, so with those characteristics in mind, what are examples of good benchmarks? We believe that the best benchmarks are composed of a well-defined, unmanaged index of many individual stocks. Such an index is durable, with restrained volatility, and is available for direct investment. Let's consider 3 possible benchmarks to make sure each one also passes the 9% performance test. In each case, we assume dividends are reinvested when calculating the return. First, the S&P 500. As a collection of 500 vibrant, multi-billion-dollar company stocks, it is the most widely tracked index in the world and can be thought of as a proxy for the entire US stock market. Over the last 30 years, its average annual return is just over 9.6%. In our judgment, the S&P 500 serves as an excellent benchmark. Next, a total stock market index fund, which includes the entire US stock market, including all S&P 500 stocks. The 30-year average annual return on this index is virtually identical to the S&P 500. Thus, it too is a great benchmark. Finally, we could broaden our benchmark even further to include an all-world stock index such as the MSCI All-Country World Index, which is made up of both developed and emerging market stocks. Unfortunately, the 30-year return, at approximately 8.5%, is just short of our 9% target. Therefore, we recommend using either of the first two funds just mentioned. On this channel, we will use the S&P 500 as our benchmark. With our benchmark chosen, how should we assess that 13% gain for 2025? Well, the result seems good, but it underperforms our benchmark result of 18%. A one-year underperformance is not the end of the world, but it suggests that we should take a close look at the contents of our portfolio as well as our trading behavior over the past year. This much we can be confident about. If we match our benchmark performance over time, we should get the financial result we need. But if our portfolio is different from the benchmark and it underperforms, it would be wise to come up with a satisfactory explanation and possibly take corrective action. Otherwise, we risk diverging from the benchmark towards an unacceptable result over time. What about this scenario? You reviewed your account performance for 2022 and found it had lost 13% of its value. Is this cause for alarm? After all, 13% is a big drop and a far cry from the 9% gain we seek to achieve. Before you panic, check your benchmark. How did it do? It turns out that the S&P 500 lost even more than your portfolio that year. It was down 18%. To be clear, neither loss is good, but we accept that the long-term performance of our benchmark will include losing years. If your portfolio outperforms during losing years but underperforms during winning years, you might come out okay in the end, but you will have to track your portfolio's ongoing performance versus your benchmark, just to be sure. Once our American Dream portfolio is up and running, that is exactly what we will do, and you will see the results in real time. We are getting very close to beginning our portfolio construction. Next up, a series on investment risk, so stay tuned.